Hey y'all, I'm Kyle, CFO and co-founder of Strata Cloud Accountants, and today I'm going to talk about the 5 KPIs that you must track, every business must track, and I'm going to do it in 10 minutes, and I'm going to save the most important one for last. So, first of all, what is a KPI? It's a key performance indicator. What does that mean? It means basically something that's measured in the business. Basically, without it, you have no way forward or you're taking a guess and relying on luck. So, a KPI is just something that's a financial metric, for instance, that you can measure month to month, apples to apples, and get a sense of how the business is doing. So that way you can make better decisions. And why that's important is because you've got to measure if you want to move forward. So the first KPI, and by the way, we believe that every business should have a CFO function, whether that's an in-house CFO, whether that's a fractional CFO, like we do at Strata Cloud Accountants, or if that's you as the business owner. You have to have a CFO function because the most important thing to do in the business is measure, and that's where KPIs come in. So the first of the 5 must-track KPIs is the most obvious, and that's revenue. Revenue is important because it's the lifeblood of the business. It's everything that the business needs to survive. Without it, there is no profit, there is no business. And an example of why it's important is, or why measuring it is important, is we worked with a client that measured their revenue on a session basis. So they had people on their team that would produce revenue by session. At the end of the month, their revenue was about 40 grand lower than they thought. And when we dug in and they dug into their numbers, they found that each person on the team was generating slightly less sessions than we had projected and they had projected. So they were able to go in and start tracking that weekly. And on our side, we were able to project if they had that lower session amount for the year, whether they would break even, make money, or lose money. So they were able to plan for the rest of the year. And they were able to do that because they started measuring revenue earlier rather than later. The second KPI is gross profit percentage. And stay with me, this one's a little bit more complicated than revenue, but it's still very simple and straightforward when you understand what it is. So I'm going to use the example of hamburgers. If you sell the hamburger, that's your revenue. The direct costs that go into making the hamburger, aka the ingredients like the bun and the burger patty, that is your direct cost. If you take your revenue for selling it minus your direct cost and say your revenue was $10, your direct costs were $5, then your total gross profit would be $5. To get the percentage, you just take that gross profit number of $5 and divide that by the sales, which we said were 10. So in this case, your gross profit would be 50%. Why is percentage important? Well, we don't really get a good measure of how we're doing if sales went up twofold, for instance, from one month to the other. We'd expect that gross profit would go up as well. What's important is the percentage being maintained from one month to the next. Did the gross profit percentage fall from 50% to 40%? And why would that be? Did ingredients costs go up? Did we have a bad inventory count, for instance? If we're counting all of our hamburger patties and buns at the end of the month, did we miss something? Those are the questions that we need to answer, and we can't answer them unless we look at the percentage number rather than the overall dollars. So one example where that was important with a client we worked with, they had liquor costs because they sold liquor, beer, and wine shoot up from one month to the next, and we didn't know why. So we figured out it wasn't a technical issue or an inventory issue. They had actually had an input cost or an ingredients cost go up fourfold over the course of that month because of a supply shortage, and that caused the cost to spike up, and conversely, the percentage of gross profit as a percentage of sales to go down about 3 or 4 points. And for the volume they were doing, that was thousands and thousands of dollars that month. So what they did was, one, they were able to adjust the price slightly to compensate, and they were also able to find an alternative supply at a much more reasonable cost that didn't affect the quality of the drink they were selling. And with those two things, they were able to get more money on the top line and then save more money in cost to maintain the gross profit and bring it back to the level that it was in prior months. If they hadn't have done that, they would have thousands and thousands of dollars every month sitting on the table that would be compounding because they weren't measuring. And once again, that's what a KPI is. It's just a measurement from month to month, so you can pivot the business and you can make the decisions that you need to make sure that you're maximizing profit. The third one, skipping down to the bottom of the profit and loss statement, is net income. And this is different than cash. This is actual operational income, all of your revenue minus all of your costs from one month to the next. And one example of why this would be an important metric is we had a customer that was expecting, when we came on with them, they were expecting to have positive net income, basically have a profit for the business. Instead, they had negative net income. And when we dug in, we found it was actually a technical issue with the way they were recording sales tax. They were recording it as an expense instead of putting it off on the balance sheet where it belonged. So in that case, it was a technical issue. But once again, if you're not measuring it, you wouldn't be able to ask that question. And you don't have to be an accountant to find that your net income was a surprise to you. You could then reach out to an accountant, or you could do it yourself, like we said. But either way, you have to have that function of measuring, because in that case, we were able to find out they weren't doing as bad as they thought they were doing, and they were able to make better decisions about future growth because they knew they were getting accurate bottom line numbers. The fourth KPI is net income percentage. And that's similar in importance to gross profit percentage, because you want to know as a percentage of sales how you're doing with net income. So for instance, we work with a client that their net income was much higher year over year from one year to the next than it was in the previous year, which is great. But as a percentage of sales, it was lower than the previous year by about 10%. When we dug in there, they were having consistent salary issues where their salary count had grown from one year to the next to try to support the sales. But we found that they found that there was some redundancy there as well. Their cost to the landlord went up, their occupancy costs went up. And so those two things cut into their bottom line percentage. They were able to negotiate a percentage rent adjustment with their landlord. So the landlord benefited on the upside if they had higher revenue, but they had a floor where they could lose less. And they adjusted their salary structure as well to make it more commission-based, so they could incentivize people to generate the revenue and preserve their profit percentage on the bottom line. So it's important to look at net income, but it's also important to look at net income as a percentage of sales, so you can make those adjustments and make sure that, once again, you're not leaving money on the table from month to month to month. Finally, the most important KPI that you need to track, and probably the most intimidating, so it's one you've got to do it and look at it, and then you can figure out what you need to do from there, and that's net cash flow. So you might think, I don't know how to look at a cash flow statement. That's fine, as long as you can run it in QuickBooks, for instance, or whatever software you're in. If you can go to the reporting module, if you can run a P&L, a profit and loss statement, if you can run a statement of cash flows and look at the bottom line number of each of those. So look at the net income number on the profit and loss and look at the net cash flow number on a statement of cash flows. If you can look at both of those and see if there's a difference, and just ask the question why, because that can answer a lot of things about what's happening in the business. One powerful example to hopefully make it more clear, we were working with a business that wanted to expand. They wanted to open a new location, and they had good cash flow, they thought, or steady cash flow in their business. When they gave the financials over to the bank came back and said, we can't lend you money. And they said, why? We have steady cash flow. They said, well, your accounts payable, your payables are getting bigger and bigger and bigger month over month over month. And we are concerned about that. We don't want to lend money to then have that money go to pay short-term payables instead of pay for the expansion that you're looking to do. They were very surprised and had to go back to the drawing board and deal with the payables before they would have a chance to get a loan. They could have addressed that or found that earlier if they had looked at that bottom line net income number on the profit and loss statement, and they'd looked at the net cash flow number and just seen that they were different. Because in this case, they would have seen that net income was a lot lower than the net cash that was coming into the business. And they would have been able to at least ask why or start investigating to see why is the net income number negative, for instance, and the cash flow a steady or break even. And they would have seen the reason is because we're not taking that cash and paying off vendors, and that vendor balance is getting bigger and bigger and bigger and bigger every month. So that's just one example where it's so important to look at those KPIs every month, especially look at the difference between net income and net cash flow, and you can start understanding the business top to bottom. And this works for businesses, huge enterprise level businesses all the way down to sole proprietor, single member, mom and pop businesses, no matter what the size is. If you're measuring those KPIs that I mentioned, revenue, gross profit percentage, net income percentage, and net cash flow, and really looking at the difference between those two or between all of those from a month to month basis, you can start answering all the questions about your business and pivot it and make sure that you're making the most profit possible.